TheoTrade. This is Don Kaufman. September 11th, 2020. Minutes left inside of this trading day here on a Friday afternoon. We've got volatility lower throughout the course of this trading week with the marketplace incrementally lower. We've got a problem here, people, and that's exactly what we're going to break down in this weekend's update. Let's get to work. When I talk about volatility lower, the marketplace lower, okay, the marketplace, first and foremost, I am distinctly talking, okay, and specifically talking about the S&Ps. So we're going to start this week by looking at the SPX, and specifically the SPX and its expected moves. Now, I'll talk about this, of course, when I start talking a little bit and looking at expected moves, but throughout the course of this week, we had approximately $107 expected move. Now remember, that's $107 higher and or $107 lower. Now, what did we get? Well, again, it was a 4-day week, and for a 4-day week, that's actually rocking, right? $107 move, we tagged it today. And when I talk about like tagging the edge of an expected move, you got to look at this. It's just absolutely uncanny. Not only did we hit the edge of the expected move, but we held on to it like it was grim death. We bounced off of it. I wouldn't be surprised in the next 5-6 minutes here to see us actually close right back down into the edge of that expected move. You know, if there's one thing, before I go any further, that would characterize this entire trading week, not just today or yesterday, you've had 4 days that have just been downright sketchy. And I know that that's, that's a great term for the marketplace. No. Take a look. We are looking at a 1 day, 1 minute. And look at some of these candles here. Now, this is not, the Nasdaq futures. This is the S&Ps. This is the SPUs. The SPUs are moving in like 5 and 6 point ranges inside of 1 minute. We've had up to, again, 10-point S&P ranges inside of 1 minute. It is downright sketchy out there. And that's today. And today, could you call it volatile? I don't know. I think this is kind of an inside chopped out day. Maybe not for the Nasdaq. Inside chopped out day. But when you start getting, okay, back-to-back days, and again, I keep reiterating this, look at the size of some of the moves. And again, we're all the way down to a 1 day, 1 minute, 10, 12-point moves back-to-back over here. People, okay, there is a much larger move in play here. You just haven't necessarily seen it rear its ugly head. So when we're looking at the SPX, okay, on the week, and again, I'll deviate back over to the SPX. The SPX is, should we say substantially lower? Remember, there's about a $107 expected move, okay? We're just off some of the lows, so you've moved, again, incrementally lower on the S&Ps. Now, when it comes to the Nasdaq, Nasdaq's a completely different story. I mean, the Nasdaq, if I apply these auto-expected moves, man, the Nasdaq actually lost the edge of the expected move. Unless there's a big rally in the next couple of moments here, the Nasdaq, again, is going to lose the edge of the expected move. That's beyond incrementally lower, people. That's just downright lower. So what's the cause for concern? Okay, what should we care? Because volatility is lower and the marketplace is lower. Well, first of all, it ain't supposed to work that way. Let me actually bring up right now, okay, a comparison chart. So I'll script this out for you very cleanly. What you happen to be looking at right here, right now, is the SPX. Okay, the SPX is the primary. Right there is the SPX. Down below over here is none other than the VIX. Now, this is a chart that's brought up by people all the time, right? They almost look like a mirror image of one another. Here's obviously March, and there's huge sell-side activity inside of the market at the onset of COVID. The VIX absolutely spikes. The VIX contracts. The marketplace rallies. We laugh, we cry. Here's another spike of the VIX and some sell-side activity. All of a sudden, people, everything changes. Okay, and when does it change? And this is the important kind of takeaway here. And again, this comparison chart's everything. I'm actually going to take the comparison and I'm going to knock it down to a time frame of 3 months. We're going to come over here to time frame. We're going to drop from 9 months, okay, and we're going to come right into 3 months, hit okay. So there's 3 months. So what changed in here? Well, during what was an absolutely magnificent gamma squeeze, which appeared to ensue right around here. Now remember, that is the SPX. The SPX is exploding to the upside. All of a sudden, somewhere here in like late August, the VIX actually took off to the upside. So the VIX takes off to the upside, and the VIX was actually on a steeper incline than the SPX at that point, which it should be because the VIX is actually a more volatile instrument. All of a sudden, sell side activity hits. Again, we've been in the sell side for about a week, and the volatility is falling. First of all, that's not necessarily a negative thing if you understand it as a trader, because usually when the marketplace is falling, you have volatility pumping up. But when the marketplace is falling, and again, here is the big opportunity, as this marketplace is falling, you're actually getting higher degrees of historical volatility, which is actual price movement. So historical vol is actually higher. But at the same time, we call implied vol is headed lower. That, for me, is an opportunity because I'm actually out there being a buyer of that implied volatility. I'm a buyer of the implied volatility. Why? Because we're still getting a lot of price action. Historical volatility kind of exceeding, some of the price action that options denoted to. So it's not all bad. But volatility lower at the marketplace lower. We just looked at the VIX versus the SPX. I also want to spin around for a second and take a look at the VVIX because the VVIX today is also, demonstrably lower. And when I look at the VVIX is the volatility index. Now, this is not a tradable product, What you're looking at over here is the vol, of the VIX. For some unknown reason, the vol of the VIX is also falling. So are we, and here's the closing bell. That's it. It's over. So the volatility of the VIX is also falling along with the marketplace falling. Is it traders taking off hedge? There's a lot more questions here than answers. And we're going to be taking a look at this because I think that the volatility falling on the VIX itself is also going to be opportunistic. It's give us some opportunities to actually buy volatility in the VIX itself, probably this next week. Not to mention, of course, you have a Fed announcement this next week, a ton more economic data. That's right. We're coming into another Fed announcement. It's going to be wonderful out there. But back over here. So why do we care? One of the things I got to stress to you again, volatility lower at the marketplace. Why do we care? A lot of this to me, has to do with your bias as a trader in the marketplace. So we're going to cruise back over to the QQQ. And in looking at the QQQ, you see, again, what has become some fairly hostile sell-side activity. Now, when I pull up what's called an IV, this is an implied volatility range. What you're actually looking at is an IV ranking. Again, hostile action in the marketplace, cannot stress this enough, as that hostile action in the marketplace is literally gripping hold, and I'll zoom in here for you, There's the QQQ selling off. This is actually what? The IV rank coming down. Again, huge question mark over there. But the point, again, the point of me kind of delivering this to you is to simply say this. It's not just volatility coming off with the marketplace lower that's starting to bother me, Volume is also dropping off, on absolutely key stocks. I look at this as, in many respects, as a warning shot being fired. The QQQ is still sustaining decent elevated volume here. Obviously, this volatility had some real spikes, but here we are slipping lower, and the volume in a very large way has started again to contract. So it's great. Well, now let's start to actually put the pieces of the puzzle together. So we start looking at this again. Volatility is lower, the marketplace is lower, volume is actually dropping off. Now let's start to look at some stocks, because here's where I'm going to tell you, not only does it matter, but this is where we really need to start to pay attention. And as you look at a stock like Apple, which has also come off, its volume is just humdrum, completely and totally normal. Now, I haven't looked at the volatility just yet. So we take a look at Apple, right? Then we're going to take a look and a glance over at Facebook. Take a look at Facebook. Some pretty severe sell-side activity. Volume, negligible. You can take a look at Amazon. Volume, negligible. There's a lot of trading days. It's much bigger over here. Tesla, Tesla, even with the sell-side activity, shrug your shoulders right now, And again, why am I paying attention to this? Well, you know what? Have you ever seen a marketplace that was in the midst of volatility? In the midst of volatility, with volume dropping and volatility dropping. Because everybody wants to kind of try to answer the question, did we just see, just a flash in the pan here? Or is this going to be, volatility that's going to be a little bit more duration. And I think that there's some answers in here, and that's exactly why I am spending, the first, 10, 12 minutes here at the weekend update on it. Because Tesla, let's actually put Tesla into a year-to-date percentage and zoom in on it. Tesla was up almost 500%, okay? Collapsed down, then it's only up like, 300%. That is a huge, okay, move to the downside. And again, if you start looking at pricing, that's from $500, and again, this is post-split, $500 all the way down to $340, okay? Now you're having that kind of price action on declining volatility. You're having that kind of price action on declining volume. How does that make me feel warm and fuzzy? Oh, it doesn't. It doesn't. I'm going to tell you right now, you think somebody's going to come in here and buy this dip? You better believe it. People are going to come in here, okay? People are going to come in here and try to buy this dip, but I'm telling you right now, selling hasn't really kicked in. Volatility says so. Do not buy these market dips, okay? It's not just Tesla. Go take a look again at Apple, all right? So Apple, and let's go look at the implied volatility of Apple. Apple's volatility isn't just down. It's down big. And again, when you start looking at the numbers over here, it's fallen from 138 all the way down to 110 on a percentage basis. This is huge. These are absolutely huge moves with, again, the volatility collapsing. Now, the volatility collapsing probably has a lot to do with this huge gamma squeeze that's going on. But the thing that really resonates with me is that volume isn't picking up. Okay, so if retail clients are driving a lot of this, and this is where everybody's like, it's SoftBank, it's this. Listen, SoftBank had $4 billion of call options. It ain't even a drop in the bucket. There are tens of millions of traders, okay, involved in that gamma squeeze to the upside. But the unwind of that gamma squeeze, it doesn't look like, not only doesn't it look like it's really kind of ensued, it hasn't kicked in yet. I mean, you got to go through and unleash, okay, volatility for sell side to be done. Now, I'm not here to promote that this marketplace is going to sell off into the oblivion. That is not the intention, okay? I am telling you right now, though, it's actually one of the most dangerous sell-offs that we've ever seen in any recent history. And that, I think you have to respect, okay, the move that you're seeing on the screen. Volatility is collapsing back down with the marketplace going down. There's no volume in the marketplace. All of a sudden, nobody cares. The interest is lost. But retail clients, you know that they haven't dumped. Because if retail clients were dumping, these volumes would be through the roof. How do you know that? Because then market makers are going to have to sell into it. Okay, you're actually going to flip over the gamma trade. When markets go down, market makers have to sell into the selling, okay, to neutralize their delta. There ain't no neutralization of delta in Apple. Okay, Facebook, please. Okay, like Facebook, I mean, what is this? This is like light summer trade going on in Facebook. No one's feeling the fear. No one's feeling the fear. And I'm telling you right now, when it comes to sell side activity, that's what you need to see. Okay, so again, the big story in here, volatility's lower, the market's lower. Volume is actually doing nothing over here. You compare the SPX to the VIX, they're actually moving in tandem. They should obviously be moving contrary to one another. Okay, Apple's volume is down. Facebook, it's humdrum. Okay, again, volume dropping on stocks selling off. Dogs and cats living together. These are not warm and fuzzy topics over here. As I said, selling hasn't really kicked in. Volatility says so. Volume says so. Do not buy the market dips. And you're going to be inclined to do it. And I'm telling you right now, this marketplace, this is going to take a long time to resolve. And everybody's trying to handicap already what the election is going to do and so forth. You got to get that out of your mind. You got to get back to what you know as a trader. And, if you're like, I'm newer, I don't know anything, okay? Sit on top of your hands on some of these trading sessions because things are about to get wicked in this marketplace. And I'm going to reiterate this time and again, even if you see this marketplace bid up, they're coming for it. And they're going to sell into it. And that's why I'm telling you right now, you want to try to buy the dips over there, you're going to get left in the dust, okay, on one of these dips that you're going to try to buy. And it is, again, it's going to get incrementally more dangerous, okay, in the very near future in this marketplace. All right, let's throw a couple opportunities at you. Yeah, that was a nice, fun conversation. Let's throw a few opportunities at you. There's two opportunities I see in the marketplace, okay, stuff like XLU. XLU, quite entertaining, the utilities. All right, so here's another one where you see some sell side activity in the marketplace. This one just doesn't resonate with me. There's nothing. Like the professional world isn't doing anything. Okay, the fund managers and so forth, they're baffled. Why am I saying this to the XLU? The XLU is the utility sector. Nobody cares about utilities. Nobody cares about utilities except they do pay a 3.2% dividend. which is a lot better than you're going to get on a 10-year, because a 10-year right now, if you look at TNX, okay, it is, yeah, that's 0.6%. It's not 6%, that's 0.6%. So the 10 years at 0.6%, okay? What doesn't make sense, when you see some sell-side activity, the XLU, it isn't moving. No, there's no fear trade going on. So the XLU, there's no fear trade going on. Nobody's running into bonds right now. The professional world seems like they're just sitting on their hands as well. And that's where that VVIX comes in. That VVIX contracted because the professional world is like, let the retail traders, okay, hold that bag. There's nobody moving in. One of the opportunities here in the very near term could be the XLU. We're going to keep an eye on it. That's all I'm going to mention in the XLU at this point. Okay, I wanted to show the XLU specifically, again, specifically because it's not moving, right? And it's not moving, but its volatility is actually still fairly high. So the opportunity isn't there yet, but we're going to keep an eye on the XLU, okay, for a number of different trade opportunities. The other one that I have been working in and out of day in and day out is the HYG. Now, I've actually mentioned the HYG a couple of different times here, and you can see I've got some size in here. So what do I have on in the HYG? We'll bring up the chart really quick. First of all, the HYG is also doing absolutely nothing, but we know that historically speaking, the HYG, okay, when markets get a little bit wicked, so does the HYG. And right now, we get absolutely nothing. What do we anticipate out of the HYG? I anticipate that if the spiders were to tank, it's going to yank the HYG along with it. And that's why in the HYG, I am doing a risk twist spread. I've mentioned this a few times in videos, but that trade is still there. Why am I looking at the HYG? It's junk. Why am I looking at it? Because the volatility is rock bottom. You tell me, where else can you buy volatility? Okay, like that. When I say like that, clearly I'm buying December volatility. I'm buying DECE volatility. It's 18%. Let me show you. Where's DECE volatility in some other products out there? Go cruise over to the spiders. Okay? Cruise over to the spiders. Go out like, you know what, December, because I was in December's expiration. 98 days. Look at that. 31% implied volatility. So I'm buying volatility right now in the HYG for half of what it's going to cost inside of the spiders. And I'm using a risk twist spreads. For those of you that know your risk twist spread, get it on, people. Again, get it on, because if something's going to happen in the next 100 days, yeah, I want to be part of it. Last but definitely not least, again, in the S&Ps, we hit the edge of the expected move. That's one of the things that's just, again, it's uncanny about a marketplace that's this wild. I mean, literally, okay, yesterday, this is the beginning of the week. That's where we started the week, okay? We started the week pretty much right over here at the 3430 level. We came down, 100 handles yesterday, bounced a little bit this morning, saw us trade right to the edge of the expected move, bounced, and cruise out the week, again, just north of the edge of the expected move. It's all about the expected move, which actually brings me to the point. As I said, we had a $107 expected move from last week, which was only a 4-day trading week, right? What's the expected move looking like this next week? So we have a Fed announcement, all of this, other economic data that's going to drop. And yet this next week, there's not even a $100 expected move. People, I got more questions there than answers. Okay, think about that for a second. We just saw, okay, what amounted to that full $107+ move. Okay, take a look. Those lines on the screen, that middle line right here, okay, from here to here is $107. Not only did we hit it, we extended past it. So you're telling me in 4 trading days, we move more than $107. Okay, move more than $107. Now we're going to come into a 5-day trading week. 5-day trading week with what? $100 expected move and a Fed announcement to boot. I am a buyer of option premium. I am absolutely a buyer of option premium. To me, that volatility in the near term over here, it's still rock bottom. The marketplace is too efficient. Okay, there are just too many things in this marketplace that simply don't add up. And I think that that's the opportunity right now. You got the volatility that's actually headed lower. You've got the marketplace headed lower. And I got a lot of problems with that. Again, for this next week, and I'm not gonna sit here and get all kinds of bearish on you. For this next and coming week, restrain yourself from trying to buy the dip, okay? Because I'm telling you, a whole lot of retail traders are going to get caught in the crossfire of just that. Markets are excellent at drawing more of your capital into bad positions. Don't do it, okay? If you're going to get bullish, if you're going to try to go after dips, use spreads. Define your risk. Keep your hands and feet inside of the vehicle at all times. Because people, this looks like just the beginning of what is Pandora's box of volatility. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.